The rise of the Dragon China's economic transformation. China's economic ascent has been nothing short of remarkable. Over the past few decades, the nation has undergone a profound transformation, evolving from a largely agrarian society into a global economic powerhouse. For decades, the nation experienced unprecedented growth, with its GDP expanding at an average rate of nearly 10% per year. This rapid development has been driven by a combination of factors, including significant investments in infrastructure, a focus on manufacturing, and a shift towards a more market-oriented economy. This transformed it into the world's second-largest economy, trailing only the United States. The financial districts in cities like Shanghai and Beijing have become symbols of China's economic might. Millions were lifted out of poverty as economic opportunities expanded and living standards improved. The Chinese government implemented policies aimed at reducing poverty, which have had a profound impact on the lives of its citizens. Cities boomed with construction and innovation, with skylines dotted with cranes and new buildings. Major urban centers like Shenzhen and Guangzhou have become hubs of technological advancement and economic activity. China became the world's factory floor, producing goods for every corner of the globe. From electronics to textiles, Chinese factories churned out products that fueled global consumption. Its appetite for raw materials and energy reshaped global trade patterns. The demand for commodities like oil, coal and metals surged, impacting economies around the world. The world marveled at the speed and scale of China's economic miracle. The transformation was so rapid that it seemed almost surreal, with entire cities springing up in a matter of years. This success was fueled by a potent combination of factors, including a vast labour force, strategic government policies, and an openness to foreign investment. The government implemented market-oriented reforms, which included opening up the economy to private enterprise and reducing state control over certain sectors. These reforms unleashed entrepreneurial energy and attracted foreign investment. Multinational corporations flocked to China, eager to tap into its vast market and benefit from its competitive manufacturing prowess. A vast and disciplined labour force provided the backbone for manufacturing expansion. Workers in factories across the country played a crucial role in driving economic growth. China's entry into the World Trade Organization in 2001 further integrated it into the global economy. This move opened up new markets for Chinese goods and facilitated greater trade and investment flows. The world embraced China's rise, eager to tap into its vast market and benefit from its competitive manufacturing prowess. International businesses saw China as a land of opportunity, leading to a surge in foreign direct investment. However, this rapid growth came at a cost. The environmental impacts of industrialization became increasingly apparent, with pollution levels rising and natural resources being depleted. Environmental degradation became a serious concern, as smog-blanketed cities and water sources became contaminated. Additionally, income inequality widened, creating social tensions and disparities between urban and rural areas. Income inequality widened, creating social tensions. The gap between the rich and the poor grew, leading to discontent and calls for more equitable distribution of wealth. The Chinese model, reliant on exports and investment, became increasingly unsustainable. The heavy focus on manufacturing and infrastructure investment led to imbalances in the economy. The global financial crisis of 2008 exposed the vulnerabilities of this model. The crisis highlighted the risks associated with over-reliance on exports and the need for a more balanced economic approach. China responded with massive stimulus measures, but these further fueled debt levels and created asset bubbles. The government pumped money into the economy to maintain growth, but this led to concerns about financial stability. The stage was set for a slowdown. As the effects of the stimulus measures began to wane, signs of economic deceleration became more apparent. The warning signs were evident for years. Analysts pointed to issues such as overcapacity in key industries, rising debt levels, and slowing productivity growth. Excess capacity in industries like steel and construction signaled overinvestment. The boom in these sectors led to a glut of supply, which in turn depressed prices and profitability. local government debt ballooned, raising concerns about financial stability. Many local governments had borrowed heavily to finance infrastructure projects, leading to worries about their ability to repay. The trade war initiated by the Trump administration added further pressure on the Chinese economy. Tariffs and trade barriers disrupted supply chains and created uncertainty for businesses. Despite these challenges, the Chinese government maintained an outward facade of confidence, touting its economic resilience and commitment to continual growth. Officials emphasized their ability to manage the economy and navigate through difficulties. However, beneath the surface, cracks were beginning to appear. The combination of internal and external pressures suggested that China's economic model would need to adapt to sustain long-term growth. Cracks in the foundation property crisis and deflationary pressures. One of the most alarming signs of China's economic troubles is the deepening property crisis. For years, the real estate sector has been a key driver of economic growth. It has also been a major source of wealth for Chinese citizens. However, this growth has been fueled by speculation and easy credit. This has led to a massive oversupply of housing. Ghost cities with rows of empty apartment buildings stand as a testament to this excess. The bursting of this property bubble has had a ripple effect throughout the Chinese economy. Major property developers, saddled with unsustainable debt, have defaulted on their obligations. This has shaken investor confidence and led to a sharp decline in property prices. Homeowners who had invested heavily in real estate are facing mounting losses. The construction industry, a major employer, has been hit hard by the slowdown. Adding to the economic woes is the spectre of deflation. Consumer prices have been falling for months, indicating weak demand and raising fears of a deflationary spiral. This is a dangerous situation, as it encourages consumers to delay purchases in anticipation of lower prices. This further depresses demand and exacerbates the economic slowdown. The Chinese government is facing a difficult balancing act. They're trying to stimulate the economy without further fueling debt and asset bubbles. Stephanie, media aerial view of the Chinese government trying to avoid asset bubbles while stimulating the economy. It's really tough right now. Many of us invested in property thinking it was a safe bet. Now, with prices falling and developers defaulting, our savings are at risk. It's a very uncertain time. The government has been implementing new policies to try and stabilize the market. Financial analysts are debating the potential outcomes of these measures. Citizens are hoping for a swift economic recovery, but the road ahead is fraught with challenges. The global economy is also watching closely, as China's economic health has far-reaching implications. International markets have already started reacting to the property crisis, with fluctuations in stock prices and investor sentiment. Economists predict that the long-term effects of this crisis could reshape the global economic landscape. Despite the challenges, the resilience of the Chinese community shines through as they work towards recovery. The ripple effect global impact of China's slowdown. China's economic slowdown has sent shockwaves through the global economy. As the world's second-largest economy and a major consumer of raw materials and manufactured goods, China's reduced demand is being felt across the globe. Emerging markets that rely heavily on exports to China, such as those in Southeast Asia and Latin America, are particularly vulnerable. Economists, the slowdown in China is having a profound impact on global commodity prices. Countries that depend on exporting raw materials to China are facing significant economic challenges. The luxury goods sector, which had come to depend on Chinese consumers for a significant portion of its sales, is also feeling the pinch. Brands like Louis Vuitton and Gucci have reported slowing sales growth in China as consumers tighten their belts. The automotive industry is another casualty, with car makers facing declining sales in the once booming Chinese market. The impact is not limited to the private sector. Governments around the world are also grappling with the consequences of China's economic slowdown. Reduced demand for commodities has led to lower prices, hurting the economies of exporting countries. The slowdown is also casting a shadow over global infrastructure projects, as China's Belt and Road Initiative faces funding challenges. Multinational CEO, our company has had to adjust our forecasts and strategies due to the slowdown in China. The reduced demand is affecting our bottom line, and we're seeing similar impacts across various sectors. It's a challenging environment for global businesses. Geopolitical headwinds, trade wars, and technological competition are reshaping the global landscape. China's economic challenges are exacerbated by rising geopolitical tensions, particularly with the United States. The ongoing trade disputes have led to significant disruptions in supply chains and have impacted the livelihoods of many workers. The trade war, initiated by the Trump administration, while somewhat eased under President Biden, continues to cast a shadow over bilateral relations. Despite several rounds of negotiations, many issues remain unresolved, creating an atmosphere of uncertainty. Tariffs remain in place on billions of dollars worth of goods traded between the two countries. These tariffs have not only increased costs for businesses, but have also led to higher prices for consumers. Beyond trade, the US and China are locked in a strategic competition for technological dominance. This rivalry extends to critical areas such as artificial intelligence, quantum computing, and space exploration. The US has imposed restrictions on the export of advanced technologies such as semiconductors to China. These restrictions aim to limit China's access to cutting-edge technologies that are crucial for its technological advancement. This is an attempt to curb China's rise as a technological powerhouse. The US is keen on maintaining its technological edge and sees China's rapid advancements as a potential threat to its global leadership. These restrictions have had a significant impact on Chinese companies, particularly in sectors like artificial intelligence and 5G telecommunications. Chinese firms are now seeking alternative sources and investing heavily in domestic innovation to mitigate these challenges. The Taiwan issue remains a major flashpoint in US-China relations. The island's strategic location and its significance in global supply chains make it a critical point of contention. China views Taiwan as a breakaway province that must be reunited with the mainland by force if necessary. This stance has led to heightened military activities and increased tensions in the region. The US, while officially adhering to a One China policy, has strengthened ties with Taiwan and provided it with military support. This support includes arms sales and joint military exercises, which Beijing views as provocative. The potential for miscalculation or accident in the Taiwan Strait remains a significant risk to regional and global stability. Any conflict in this area could have far-reaching consequences, affecting not just the immediate region, but the entire world. Political analyst, the strategic competition between the US and China is not just about trade, it's about who will lead in the technologies of the future. This competition will shape the global order in the coming decades. The restrictions on technology exports are a clear indication of this struggle. Both nations are investing heavily in research and development to outpace each other. The Taiwan issue only adds to the complexity and the risk of conflict. Diplomatic efforts are ongoing, but the situation remains precarious. It's a very delicate situation that requires careful navigation by both sides. The stakes are high, and the outcomes of these negotiations will have lasting impacts on global stability and economic prosperity.